Hello guys and welcome back to the new video of Nova Forex. So, in this video we would explain you all the basics of the Forex trading, like how to read and analyze the candlesticks patterns, and then at the end, we would reveal the strategy that you can use along with the candlesticks in order to make up a profitable trade into the market. Now before we commence the video, be sure to subscribe our channel and hit this bell icon so that you do not miss out any of our new videos that are being uploaded into the channel. Now let us begin the video. Let us first learn about the basics of the Japanese candlesticks. First of all, what is a candlestick and what does it represent? A candlestick is a graphical summary of market price movements within a period of time. They are basically the trading tools that helps the investors or traders to know about the opening price, closing price, high and low of a stock or a currency. Let us see how the candlesticks helps the investors in knowing opening, closing, high and low of a particular week, day, hour, or minute. So, here as you can see that we have a bearish candle as well as a bullish candle on our screen. The candle is basically made up of two things, which are body and its wicks. In this bearish candle, the opening price was from the body's upper side, which means this area, and then the market went a little above and made this high, and then it went below. The closing price was at this end of the body. The body of the candle shows the difference between the opening price and closing price of the stock. If the opening price is lower than the closing price of the stock, then the candle is bullish, and if the closing price is lower than the opening price, then the candle is bearish. Now let us learn about the wicks. The wicks are very useful to a trader as it shows exhaustion into the market. Through the wicks of the candle, we can know the strength of the buyers as well as the sellers into the market. So, when a candle creates wicks above or below it, then it represents that the market has made high or low for a particular time. So, in a bearish candle, this wick above the candle indicates that the buyers pushed the price at this point, but then the sellers took the control of the market and hence, they pushed the price to the downside, which resulted in market making this bearish candle. The lower wick of this bearish candle indicates that the sellers pushed the price at this point, but due to some buyers into the market, the price went above and it closed at this end of the body. This candle basically indicates that the sellers have the control of the market currently. Similarly, in the bullish candle, the lower end of the body is the opening price of the currency pair or stock. And the upper end of the body is the closing price. The wick below this lower end of the body indicates that for some time the sellers took the control of the market and pushed the price to the downside. But then the buyers gained the control into the market and pushed it to the upside, which resulted in creation of this bullish candle with big body. And this wick, which is above the upper end of the body, indicates that the buyers pushed the price till this point. But due to some of the sellers, the price went a little below and closed at this point. This candle simply indicates that the buyers are in control into the market. The price basically runs according to its supply and demand forces. A lot of buyers and sellers fight against each other, which can be seen through the formation of these candles into the chart. For example, when the market makes a candle like this where the upper and lower wick is bigger than its body, then it indicates that there are a lot of buyers and sellers who wants to buy or sell at this point. And this is why this candle is called indecisive candle, as we could not know who are in control of the market. This candle mostly occurs during the end of the previous trend or at the beginning of the new trend. And sometimes, this indecisive candle is also formed during a continuous trend, which makes a pause in its existing trend for some time and then it again continues going into its existing trend. The second candlesticks which we are going to learn about is the pin bar candle. A pin bar candle is a type of candles whose either upper or lower or both wicks are bigger than its body, is shown here. Let us learn about this type of candle in detail. Firstly, let us learn about the bullish pin bar candle. There are two types of bullish pin bar candles which are shown here. In this first type, the market opened at this point and moved to upside. But then due to the sellers of the market, the price came down and closed at this point. Similarly, in the second type of pin bar candle we can see that the sellers of the market took the control of the market first, but then their strength decreased due to the increased buyers into the market. The sellers brought the price till this point, but then the buyers gained control and pushed the price to upside, which is why the body of the candle became smaller and thus, the price closed at this point. This candle is mostly created when the price reaches at the higher time frame point of interest zone. This candle also indicates that the buyers have gained momentum and thus, the price may reverse and move to the upside. This candle is also used for hunting the stop loss as it has this long wick below the body. Same happens with the bearish pin bar candle. There are two types of bearish pin bar candles. So, the first type is this one. In this first type, the market opened at this point and went a little upwards. But then the sellers of the market brought the price downwards and this is why it closed at this point. Similarly, in the second type, the sellers were in control of the market as they pushed the price downwards till this point. But then the buyers took control and brought the price to this point, and which is why the price closed at this point. The bearish pin bar candle mostly forms when the price reaches at higher time frame supply zone or resistance zone. The pin bar candle basically shows the rejection from one side of the market. The rejection candles indicates the exhaustion of the prior price trend of the market. The third candlestick that we are going to learn in this video is engulfing candles. The engulfing candles are those candlesticks which engulfs its previous candle. In nutshell, these candlesticks opens at its previous candle closing or below it and closes above its previous candle. The engulfing candles are the candles which are mostly made to trap the retail and small institutions by hitting the stop loss of their trades. Let us learn this with an example. So, here we can see price is creating lower highs and lower lows. And then we see market going into the consolidation phase. We can see price going below this zone for 2 times and thus, we would call this zone as a resistance zone. Now let us wait for the market to reach at this zone. The price reached at this zone and it went above this resistance zone, which would hit the stop loss of traders who had gone short here. But after that the market made this big bearish candle, which is also called an engulfing candle, as in this candle. The price opened at its previous candle's high but it closed below its low. And thus, we call this breakout of the price as a fake breakout, as this breakout was done to hit the stop loss of the traders who had set their sell limit order at this zone. This type of fake breakout traps the retail traders as well as small institutions because they use only one time frame to trade into the market. They could have been saved from getting into this trap if they have seen the chart on the higher time frame. The fourth candlestick that we are going to learn in this video is the anchor candle. The anchor candle is basically a candle with significant longer body than the surrounding candlesticks. The anchor candles are so easy to find into the charts. The bullish anchor candle is the big bullish candle, which as you can see here. This candle's body is bigger than its previous 3 to 4 candlesticks. And similarly, the bearish anchor candles is a big bearish candle, which as you can see is formed here as this candle's body is bigger than its previous 4 candlesticks. The anchored candlesticks are very useful for traders in determining whether it is a reversal or a small pullback. In order to understand this concept properly, let us see an example. So, here we have the euro-pound chart on 1 hour time frame. We can see market creating a series of higher highs and higher lows, which is why we can say that the market is going through a bullish phase. There are a lot of anchor candlesticks here. But we would choose those anchor candlesticks which are at the discount zone and has made a break of structure. And then we see market creating this anchor candlestick. After this bullish move into the market, the price is making a pullback. Now how do we know that whether the market will reverse from this point or this is just a small pullback? In order to find this, we need to wait for the market to close below this bullish anchor candlestick's low. If the market does that, then we would look for possible reversals. But if the market does not do that and continues moving upwards after some time, then we can say that it is a small pullback which has occurred into the market. Now let us see an example of bearish anchor candlesticks. Here we have the Euro-New Zealand dollar chart on 30-minute time frame. We can see market making lower highs and lower lows, which indicates that the market is in a downtrend. We can see market creating this big bearish anchor candle at the discount zone. After this bearish move, we can see market making a small pullback. Now a lot of traders would get confused that whether this is a small pullback or a price reversal. In order to know this, we would wait for the market to close above this latest bearish anchor candlestick. If the market does so, then we can say that this is a price reversal, but if it does not close above it, then this is considered as a small pullback and not a price reversal. The anchor candlesticks cannot only be used in knowing whether the market will reverse from this point or not. Now here is where our strategy would help us. So, now we would reveal the best strategy that you can use to determine the reversal points and the pullback points into the market. Let us see an example in order to understand this strategy correctly. So, here we have the Euro-Canadian dollar chart on 1-hour time frame. We can see market making a series of higher highs and higher lows, which is why we can say that the market is going through a bullish phase. We can see market creating these big bullish anchor candlesticks which moved the price quickly to the upside. And then, we see market making a pullback here. Now, as we learnt earlier, that when the price closes below this anchor candlestick of the discount zone, then we can say that this is a reversal, but if it doesn't, then it is a small pullback. So, we can see market going below this bullish anchor candlestick. But only by seeing this, we could not say that this is a price reversal. So, in order to confirm a price reversal, we would use the multi-time frame analysis. So, we would mark the higher time frame's point of interest, and then we would switch over to the lower time frame for seeing how the market reacts when it reaches at this POI zone. So, in the higher time frame of the same chart, we can see that the market made a demand zone here and a supply zone here. Now, as the market has reached to this demand zone, let us move to the lower time frame again for confirmation and entry. So, at the lower time frame, we can see market making some bullish move. But we can consider it as a reversal only when the market closes above this bearish anchor candlestick's high. The market did this, and thus, we would draw the demand zone in the lower time frame. The market reached at this lower time frame demand zone, and which is why we would initiate our long position from this candle. Also, we can see market creating this hammer candle, which indicates that the market has rejected this zone. We would keep a risk to reward ratio at 3-to-1. And as you can see that the market hits our TP, which is why we made huge profits into the market. This brings us to the end of this video. So, in this video we explained the basics of the candlesticks, and along with that, we revealed the best strategy that you can use with the candlesticks to maximize your profits into the market. Now, before we end this video, if you found this video informative, then hit the like button and be sure to subscribe our channel and hit this bell icon to never miss out any of our upcoming videos.